thank you all for coming and being a part of our inaugural Make It Happen Multifamily webinar series episodes. We're going to be talking about the benefits of investing in multifamily real estate today. And just to put it out there, Lee and myself are not financial advisors, and we are not accountants, and we are not attorneys. So you should always check with your own personal financial planners, accountants, and attorneys before you make any decisions. All right. Okay. Here we go.
All right. So who are we? My name is Lee Fjord, and this is my beautiful wife, Meagan Fjord. And we have a company, a real estate investment syndication company called Green Forest Capital. I started Green Forest Capital in 2019. Since then, we have grown that company to manage over $50 million worth of multifamily real estate, accumulating around 700 doors in 2 states, Missouri and Arkansas. Megan and I are the founders of the Make It Happen Multifamily Education and Networking Group. That is what this group and this webinar series is placed underneath, is Make It Happen Multifamily. So it's a free event. It's something that we built this with the goal of spreading the word and love and understanding of commercial size multifamily properties. Whether you're active or passive, you can get something out of Make It Happen Multifamily. Not only do we do the monthly webinar series right here online, but we also have in-person live events called Tours and Pours, where we tour a large-scale multifamily property with the owner, and then we have an opportunity to learn from them in person. If you're ever interested in traveling to St. Louis and coming to a Tours and Pours event, I would love to have you do so. We do post them in our Facebook group, which is now up to 1,900 members. We've had it in place for about a year. So in a year, we went from 0 to 1,900 members in our group, and it's ever growing. And we're giving an opportunity for everybody to have an online presence or participation in the group through these webinars. So if you aren't already a member of the Facebook group, you probably are, because that's probably why you're here, but would love to have you as a member of our, free, open to the public Facebook group, and follow us for future events that we intend to do coming up.
Yes. And shameless plug, we're launching a YouTube channel, and a recording of this webinar is going to be on our YouTube channel, as well as some recap videos from Tours and Pours. So keep an eye out for that. So moving on, we really love real estate. If you couldn't tell, we specifically really love large commercial multifamily properties. And we're going to explain to you why exactly that is. But, we know that there are lots of options in the marketplace for investing your money, but most of these options pale in comparison to real estate, in our opinions. Mm-hmm. Savings accounts, CDs, stocks, bonds, ETFs, some of the more common options, they just don't typically perform well enough to really, truly build significant wealth. Most often, these barely outpace inflation, or they're subject to the volatility of the stock market. So think of how many people that you know who are retired and constantly worried about the stock market. Like, I know people that just literally set their budget every month based off of what the stock market's doing. Mm-hmm. And they may think they might have a diversified portfolio by having stocks invested in multiple companies or in mutual funds. But the truth of the matter is, all of their eggs are in the basket of the stock market, and they're at the mercy of it. So one of the things that we really love about real estate is its independence from the stock market.
100%. Yeah. So we love hard assets that are physical, that they're present, that they yield a great return on them. So it generally increases in value over a long period of time. So as opposed to up and down day by day, like the stock market, real estate slowly but surely increases in value. Some other people ask, what about the housing market? How does that affect, real estate investing? Well, Some people invest in single family and small multifamily properties. That's how I got started. I
Mhm.
started with a duplex in 2017, and thankfully I bought it right and in a neighborhood that was transitioning, because I'm now under contract to sell it and it's going to yield a profit, thankfully. But if my neighbor sold their property for less than
Less.
what I owe,
Or
guess
never
what?
rehabbed it.
Or never rehabbed it, or the neighborhood didn't turn around, or if it got worse, then guess what? My property would be worse, and I would have no control over that whatsoever, because the value is based upon what the neighbors sell their property for. So that's why we like commercial multifamily properties. We like commercial multifamily of 25 units or larger. Usually anything less than that, the value is based upon what your neighbor sells their property for. Anything over 25 doors or more is usually determined based upon its net operating income. It's valued like a business. And there's two different things that are the determinants of the value: the net operating income and the market cap rate. Cap rate is based upon, the unlevered return on your assets invested into a particular asset, if that makes sense. If anybody has questions about how to calculate a cap rate, you can easily Google it, or I can explain it if you just ask during the Q&A later. But so cap rate is used to compare one income generating property with the other income generating property. It determines the expected rate of return on an investment property, calculated by dividing the property's net operating income by its purchase price. So net operating income divided by purchase price, that's how you get to the cap rate.
And how do you find the net operating income?
The net operating income is provided to you by the seller. So at the end of the day, so you determine net operating gross income minus expenses.
There we go.
Yeah.
That's what we're looking for.
All right. So unlike single family or small multifamily properties, we can force an increase in a commercial property's value or the appreciation by reducing the expenses, which is my favorite way to be able to increase net operating income, or increasing income. And this is why we focus on large multifamily properties that have a value add potential to be able to reduce expenses and or increase income, because we want to force that appreciation.
That's right. So the next reason we love commercial multifamily real estate is that it's inflation resistant. Rent is a living expense, and as inflation increases, rent increases as well, naturally increasing our gross income and net operating income. Like we just said, net operating income determines the value of your property in commercial multifamily. Commercial multifamily properties also traditionally perform better during economic downturns as people downsize their living expenses, or they're priced out of the housing market and they have to rent. So those are ways that, when the stock market's down, commercial multifamily properties are doing just fine, if not better than before.
I love inflation, because the majority, I'm one of the few people who do, because the majority, if not almost our entire investment is in assets that increase in value during inflation times. So as milk increases and eggs increase, so do rent. And as the rent increases, the value of our assets continue to increase as well.
Yep. All right, next up, this is probably my favorite reason why I love real estate, is that unlike stocks and bonds, real estate assets make money in multiple different ways. First, they make money through cash flow. So your cash on cash return is your profit after all expenses and debts are paid. And so that's your money that is stable and it's predictable income, and it's coming in every single month. Then you have your appreciation. Like we just talked about, in our commercial multifamily properties, we force appreciation through an execution of a value add business plan, increasing the income and reducing expenses by making improvements to the property itself and through implementing professional management practices. In this way, we have much more control over the appreciation of the asset, and we can control and have some kind of effect over the value when we sell. Again, it's stable and more predictable income than the stock market or the housing market. Third, principal pay down. The rents generated from the properties pay down the principal on the debt. which means that every single time you collect rent and you pay your mortgage, you're gaining equity in the property. That's a wonderful thing.
Mm.
And then finally, tax income savings through depreciation. So real estate is a depreciable asset, meaning that the IRS allows us to depreciate the structure over the course of 27 and a half years, providing a paper loss for tax purposes for owners. So with our business strategy in our commercial multifamily products, we perform a cost segregation study that allows us to front load or accelerate that depreciation, allowing us to claim large deductions in the first year of ownership to offset any profits gained on the investment. Awesome stuff.
I like that it's risk adverse. My favorite part about real estate and large scale multifamily specifically is that it's risk averse. It's a physical asset which provides solid collateral and has some of the best financing terms among any asset class. And physical loss is mitigated through insurance. So if your building burns down, you have insurance to be able to cover it. Now, if there's other comparables we can make, but at the end of the day, it's an insurable asset that's able to be levered at higher than almost any other asset class in investing. So why do we invest in large properties? We want to decrease our vacancy risk. Vacancy is one of the largest expenses in multifamily, in any investment in real estate. If you can increase your overall average occupancy, you're going to increase your overall income. So for example, a single family house, if you have a tenant move out of a single family house, you are 100% vacant. But we focus on larger properties and specifically 100+ units, because if one single tenant moves out of 100 units, we're still 99% occupied and we have no issues making any of our payments, and it's stable the entire way through. Additionally, if a single family investor has major capital expenses like roof replacements, I know what that's all about.
Mm-hmm.
And it can ruin the returns of a house over years to come, or in the past, if you really think about it.
Yeah, all your cash flow is gone.
All of your cash flow is gone. And if you didn't save up that money, guess where that money is coming from? It's coming from your back pocket, because that's where you were putting it.
Mm-hmm.
3, it allows for professional management. With single family and small multifamily properties, inexperienced owners take on additional risk and buy themselves a job by self-managing their properties in order to save on expenses. If these owners hire third-party management, it can be expensive, and the small property size does not generate enough income for full-time support, leaving the owner to fill the gaps.
Lee knows all about that.
Oh, I have a basement full of tools to tell you all about the years of me fixing assets all the time, constantly.
Yes. All these things Lee and I have also learned from experience. Like, we have filled in the gaps of a property management company, that could only put a part-time manager there, or, a house that had to get a roof put on, or a toilet we had to pull. Like, we've been there, folks, and we're trying to help you not have to do that.
Yeah. Our objective is to allow our past experiences and knowledge to help fast track your reaching financial, passive income and financial independence. With our business plan, we specifically purchase properties at 100 units or larger. So we can afford to hire a regional institutional style third-party property management company with a full-time on-site dedicated property manager. In fact, we even have a manager who lives on site. Mm-hmm. And not just manager, but also our maintenance staff. So we have a full-time on-site manager, full-time on-site, ideally HVAC certified maintenance technician, because that keeps our overall expenses on a per unit basis for management and payroll down by quite a bit, because you can spread it over a larger number of units, and it allows us to take advantage of scale.
Mm-hmm. Yep. Anything less than 100 units is just not big enough to afford the payroll of full-time staff.
A 70 unit it still needs the same amount of effort to manage a 70 unit that requires one full-time on-site manager, one full-time maintenance person, whether it's 70 units or 138 units, which is our largest individual property. One manager, one maintenance guy, one manager, one maintenance guy for a property that's nearly twice the size.
Mhm.
All right, what's the last one to reduce risk aversion? It is diversification. Diversification is the name of the game with all investments. So, and real estate is not indifferent from any other types. So real estate investors can invest in various asset types and locations, providing several layers of diversification in their real estate portfolio under the structure. So as opposed to having, we specifically look to acquire assets in cities with specific traits in order to increase our likelihood of success. Landlord-friendly government in place, a diverse and growing economy, a population growth year over year of a minimum of 0.5 percentage point annually. Demographics where 30% or more of the population are renters, and the median household income can support our target rent amounts. So if we focus on places that are growing and where tenants do live, and those tenant and the population of those tenants are there, we're going to always generally be able to, we would reasonably be able to reduce the amount of risk we would have if we were going into a market where population was shrinking.
Mhm. It's supply and demand. It's
Absolutely.
simple supply and demand. There's more people coming in. Everyone needs a house to live in. They're fixed assets. They can't build them as fast as people are moving there. So what happens? Price goes up. So
Absolutely. And diversifying into multiple different markets and multiple different property sizes and multiple different locations is a great way to diversify your real estate portfolio.
Yeah, and that's one of the things that we also love about commercial multifamily, specifically syndications, because you can invest no matter where you live in different markets throughout the country. So, you're not stuck investing in real estate in your backyard. So with that being said, let's say you had $50,000 to invest into real estate and you're trying to figure out what's the best strategy for you. Here's some investment strategies for you to consider. First of all, the one that everybody goes to from the bat, buy the asset and own it 100%. Who wants partners? I want to own it all.
Yeah, it'd be wonderful to be alone on my own island by myself and have all the coconuts to myself. That'd be perfectly fine.
And Lee and I both did this. We both started with duplexes. We both owned them 100% ourselves. And we both looked like this guy in the photo with our tool belt and our screwdrivers. And we did a lot of work. As a matter of fact, Lee and I bonded over installing vinyl plank flooring in my duplex when we first started dating.
Oh, yeah. You can buy an asset and own it 100%. You can usually, with single family houses and small multifamilies, it requires 75% leverage or 25% down. So with your $50,000, you could buy one $200,000 property, which would either be an okay house or a duplex in, let's say, a not as best, a kind of more of a rough neighborhood, at least in St. Louis. That's how it would work. I would imagine in some places where some of you folks live, $200,000 probably doesn't even get you a single family house in a decent neighborhood. But that's why we don't invest in California. So you can do that. You can sign on the debt personally signing, saying, if I ever stop making my payments, you can garnish my wages. You then also have to, which is reflected on your credit report and affects your debt to income ratio. You take on 100% of the responsibility for any maintenance, repairs, and bills. And this eats up your time and your money. You're this guy here with the tool belt on, unless you're paying some other person to do it for you. You generally, the only people that I know that are successful in small portfolio ownership are also self-managing, because that's where they save all their money. And that's where the profit is in owning single family houses and small multis. So you probably self-manage the property in order to earn more cash flow. Unless you have prior experience as a property manager, you're likely to learn some hard lessons along the way. Third-party management eats up all of your cash flow and doesn't give the property what it deserves in many cases. Hopefully the housing market doesn't dip on you as well, because you may end up underwater on your asset, and hopefully your tenant doesn't stop paying rent, because they are your only source of revenue. One single source of revenue, one set of bills. As soon as that revenue source goes to zero, guess who's footing the bill?
Yep.
You are, because you personally guaranteed that loan, and you're not going to go insolvent or give the property back now, are you?
That's right.
Certainly not. Vacancy risk. So you are at the limit of what you can afford, and what you are qualified for as well. So if you don't have a high net worth, you're going to be limited to the size of property that you can actually qualify for. It's not passive. You are now, congratulations, self-employed. You have a side hustle house. Now, who here in the room has a side hustle house?
Oh, we've got a few
Yeah.
side hustle houses.
Yeah, there's a couple side hustle houses.
And they eat up a lot of my time and Lee's time. And yeah, we're obviously selling them off, since Lee's selling his
currently in the
duplex right now.
process of selling almost everything that's less than $100.
Yes.
Yeah.
Yes.
Literally under contract
Syndications
on 2 of
all
them.
the way.
Yeah.
All right. So maybe that doesn't sound like the best thing to do with your $50,000. Well,
No.
what else could you do? What mitigates a little bit of this risk here, right? So you could find a partner. Maybe you find a partner who has a little bit more experience than you do in property management, or, in maintenance, or they live locally to a property in a better market than what you're in. So here, that's great, but you also still are limited to what you and your partner can afford, because you and your partner provide 100% of the down payment money and the rehab funds, unless you can finance your construction costs. And now what cash flow you do have, you split with your partner, but most likely you're reinvesting that cash flow into the property in order to afford your unit turns and handle your vacancy costs and your maintenance expenses. We have personal experience with this in a 38 unit that we JV'd with. Didn't make a single dime of cash flow on it. It all just got reinvested into the property. And Lee did a lot of landscaping himself on that property as well.
Ask me how I know.
Yeah.
Yeah.
2020 gave him a lot of free time for landscaping. Then the property doesn't generate enough cash flow to afford a full-time on-site manager and maintenance man. So you and your partner have to fill in the gaps. Again, it's not passive. You are self-employed. So what is another option? You have 50 grand. Here's what we would tell you to do. Invest in a syndication.
You can truly maximize the power of partnerships and the power of leverage by investing your $50,000 into a large commercial multifamily syndication as a limited partner. You share in the ownership in a multi-million-dollar asset that has been thoroughly underwritten, has a strategic business plan developed by experienced real estate professionals, and is managed by an institutional style managed property management company with a full-time on-site dedicated staff. You earn quarterly distributions and cash flow, similar to a dividend that you might receive in the stock market. You share in the tax benefits of the ownership through accelerated depreciation, and you get your invested dollar is equity. So when the property is sold, your equity is returned to you, and any of the profits from appreciation on the sale of that asset at the end of the business plan, which you can then redeploy into multiple syndications in different markets, or by diversifying again and again, or go buy a boat, or a Lambo.
Do whatever you want with it.
Whatever you want with it. And then, you also participate in every aspect of it. You don't ever have to get paint under the nails. You never have to get a call in the middle of the night for a clogged toilet, or ever have to deal with or learn how to evict a tenant from either
A property.
anywhere, from your property, whether it be local or away.
Yeah.
You don't ever have to drive 9 hours to and from Michigan to turn over a single tenant for your dad's vacation property,
Right.
that you get to use 1 week a year.
You don't even
That's what I
have-
did for the
yeah.
last 2 days.
You don't even have to attend a management meeting. You literally just get your check
Mhm.
or your deposit into your account.
So at the end of the day, it ends up being, we can go to the next slide. It ends up being a scenario of partnerships where you lean on each other's strengths and skills. So syndications sound interesting, don't they? Raise if they sound interesting. Yeah. All right. So why are syndications interesting? And here's how they work. It's made up of two separate types of people, two different teams that play together. You have the general partnership team, or the GPs, or the managing members. These are experienced real estate industry professionals who make their career on making sure that these properties are managed appropriately and the business plan is executed perfectly. The GPs find real estate opportunities, underwrite them, structure the business plan, negotiate the purchase of the purchase terms, and put in place debt options. The GP has the burden of all risks. All of the risk is for the general partnership team. The at-risk capital, the money spent on inspections and earnest money and software systems and legal fees and travel expenses and administrative expenses that go into the acquisition process, and the overall ongoing management and ownership process is all on our heads, or in our hands. Mm-hmm. As well as ongoing expenses that we incur, like software systems that we have, marketing expenses, putting together networking events like these, employees, and other costs of doing business associated with finding, acquiring, and formalizing these real estate opportunities. It also requires us to be able to qualify to sign on debt. Not just, $200,000 for a duplex. I'm talking about tens of millions of dollars in debt that we personally are either signing on or putting in place through an agency lender.
Right. And these kinds of debt are like large government-backed non-recourse loans, agency debt, and you have to have a guarantor with a resume that demonstrates years of experience owning and successfully managing similar assets in order to qualify for that debt. So you can know that your GP team has folks who have been vetted to be qualified to have an asset like this.
Yep. We have one of those. Our debt signing partner has been in the business for over 25 years, bought his first multifamily in 1995. Mm-hmm. He's a large five-figure guy, or five-figure, whatever, like
more than
eight-figure, yeah, eight-figure, large eight-figure yes. Guy.
And Lee and I are qualified to sign on that now too.
Yep, absolutely. So yeah, having and partnering with the strongest potential partners is key. Mm-hmm.
And also the general partnership and the syndication structure in general, we provide limited partners with access to these deals that you would never be able to qualify for the financing on yourselves. If you were to go try to buy an apartment complex, it would be like, oh, how many apartment complexes have you owned? And you'd be like, oh, this is my first one. And they'd be like, no. Mm-hmm. So additionally, the GP also burdens the legal risk. A syndication is an SEC managed, an oversought type of structure. So there's some government regulations that we deal with, and we're the ones that handle the property management, being the landlords, handling the tenants, and dealing with the property management company. The LPs don't have to do that. So the GPs structure the syndication. We file all the paperwork with the SEC. We raise the money. We find LPs, limited partners, for the down payment money and the closing cost funds, and also sometimes, your construction money, like I said, the CapEx money. And then the GPs actively manage the asset and the property management team to execute the business plan throughout the course of the ownership. So this is a very active role. If you couldn't tell, this is all that Lee and I do full time, is real estate and managing and finding assets that we do as syndications. So with that, that's one side of the team. The general partnership's one side of the team. The other side of the team is the passive side, as you can see on this chart, the Class A members. Now, there's only like 4 LPs there, but that's just because I didn't have more space on the slide. We actually have lots and lots and lots of LPs. There's lots because usually we're raising multiple millions of dollars and the minimum investment that we take is 50,000. So, we have lots and lots of LPs that help us fund these deals and we partner with in order to make this happen. So what are some of the benefits of the limited partnership team? What is that like?
All right. So the limited partners, this is what I want to be when I retire. My version of retirement is to be a full-time LP. That's what I want to be when I fully go into retirement. But that's my version. And why? It is because it's truly passive. You truly have limited amounts. You get all of the benefits without having to do any of the work if you don't want to.
Yeah, and without burdening a lot of the risk too.
And without, the burden of the risk of signing on the debt or the time or any of those items. So it's truly passive. You own shares of an entity that then owns the asset. You invest the capital needs into fund the deal and the business plan.
Yeah, that's what the limited partnership does.
It receives a preferred return on their investment through quarterly distributions. So you get quarterly distributions of cash flows, and you have a preferred return. So the preferred return is the amount of return, the minimum return that an investor and LP will receive before the general partnership begins earning any income for their hard efforts.
That's right. LPs get paid first.
LPs get paid first. GPs get paid after the LPs reach. On ours, it's 8%. So you have to reach 8% on your money before we earn a single dollar. Then tax season is simplified. And you still get tax write-offs.
Yes, you don't have to do any of the taxes for the asset. The GP team, handles all of the taxes for the property and the businesses. And then you just receive a K1 that's negative because of our depreciation being accelerated. And, you get that split of your depreciation based on your percentage of ownership. So you just hand that to your accountant.
Yep. Hand your K1 loss to your accountant and pay less taxes next year.
That's right.
You also receive at the end of the project, you receive your investment back plus the equity from forced depreciation when the asset sells or is refinanced. You have no debt risk whatsoever. You are not signing on the loan. The bank doesn't even know you. Well, they know you exist, but they wouldn't bother going to contact you. We take on all of the debt risk. You do not have any obligation to attend meetings or participate in the business plan in any way, shape, or form, just like any other investment that you normally make in the stock market. You buy Procter & Gamble shares, and then what do? You go to the grocery store and you buy Tide. Why? Because you own Procter & Gamble stock. And that's the only reason why I know, because my grandpa used to sit there and watch the ticker. And we would buy Procter & Gamble stock because I grew up in Cincinnati. And I still wash with Tide, but
we are not sponsors of Tide or Procter & Gamble, by the way. This is shameless plug.
Yeah.
But yes, you continue to do what you do best. You keep working your full-time job, building your business, or enjoying your retirement. You truly have time freedom and financial freedom through investing this way. You don't have to learn how to be a landlord. So with that being said, there's a little bit more to dig into in syndications. So we have two types of syndications and two types of limited partner investor. So accredited investors are individuals, married couples, or businesses that meet the SEC's criteria for accreditation. And if you don't know what that is, there's a link there. You can Google it, accredited investor qualifications. Typically it is you have a net worth of $1 million, not including your primary residence, or you as an individual make $200,000 for the last 3 years in a row or 2 years in a row. Sorry, not exact, but it's in the rules, two years in a row. Or you and your spouse make $300,000 per year annual income for multiple years in a row. If you meet that accreditation standard, then you can invest in any kind of syndication, whether it's a 506C or a 506B. Now, Lee, tell us what the differences are between a 506C and a 506B.
So a 506B is a syndication that can only be done with people that we have established relationships with ahead of time. One of the main reasons for our webinar is not only to help educate, but also to create relationships and establish them early so that when we have our next opportunity, we already have an established relationship and we can have an in-depth conversation about this deal, regardless of whether it works for you or not. If you choose that it doesn't work for you, that's great. If you choose that it does, it doesn't.
Yes.
But the difference is that if we don't have that established relationship ahead of time, even if you did want to invest, we couldn't take your money. If you're a non-accredited investor and it's a 506B, 506Bs are not marketed.
Yes.
They are not allowed to be posted in Facebook or in the public eye. You're not allowed to just email blast them to every single person under the sun.
Right.
It is for friends and family with established relationships. And that goes for regardless of whether they're accredited or non-accredited on a 506B. Have to have the relationship established ahead of time.
Yes. We literally, like, if we don't know you, we can't share it with you.
Yep.
So, we can't advertise it anywhere. We literally have to know you in order to share it with you as a 506B, which is why this is so important. And with the 506C, those can be marketed publicly. We can share those on social media. We can email blast those. You've probably seen some ads on your Facebook or LinkedIn for syndicators trying to raise money for these. But those are 506Cs, and those are only available to accredited investors. So if you don't meet that SEC standard, you can't invest in those deals. So that's why it's important to get to know us and get in touch with us.
Absolutely. So our request is that if you're interested in investing passively in a syndication, that you reach out to us through our website, email address, or you can book a call through the Calendly link, or you can even just call me. That's literally my cell phone right there. And we just request that the relationship begins early, as opposed to after we already have a deal in place and it's already on the tracks and you're finding out about it after the fact. Well, guess what? It's too late then. It's too late because we may not have an established relationship and we may be structuring the syndication as a 506B. In fact, we have on our most previous one, we did a B to a C where we brought the deal to our friends and family who we had established relationships with first. And then we turned it over to a 506C and launched the marketing. But after that, we were not allowed to take any non-accredited investors' money. So let's do a fun little exercise that I like to do. Everybody pull out your phone or your calculator real quick. And let me know when you're ready. 5, 4, 3,
Thumbs up
2,
or nod your
1.
head.
If you have your calculator phone out. All right.
There we go.
Now we were talking about investing an amount of $50,000, 5 and 4 zeros, 50,000. So our business model is based upon doubling our investors' money at minimum, at very, very minimum, doubling our investors' money every 5 years. So multiply that by 2. Now multiply it again. One more time. All right, here's the last time. How much does that come to? Who wants to put it in the chat? I can tell you, it's math. It's $50,000 or it's 50. It starts at 50. It's not 50 because that'd be the stock market. It's $800,000, right? So you turned 50,000 into 800,000 in 20 years. That's how long it took for you to turn 50,000 into 800,000. Now take that 800,000 and multiply it by 8%, so 0.08. That is our minimum level of cash flow returns that we give to our investors or our investors receive. The minimum you earn in distributed cash flow before my active team earns a single dollar, our active team earns a single dollar. And you better believe we are not in the business of working for free. So you will, and on most of our projects, including the one pictured here on the screen, has hit that 8% since day one. So I can tell you that I can go back to it unless anybody wants to throw it in the chat. The 8% of 800,000 is $64,000 a year. So if you invested $50,000 into one of our projects and kept that money reinvested into multifamily syndications on 5 separate deals or 4 separate deals, 5 years each for a total of 20 years, you would be earning $64,000 a year
Off of that invested cash.
in cash flows, in dividends that come in with no effort. You don't have to own a plunger. You don't have to worry about debt refinancing. You don't have to worry about making trips to Detroit, where your vacation house is. You don't have to deal with any of the risks or the issues.
Yeah.
Now, just imagine doing that. My version of retirement, just to kind of go back to kind of where we intend to be, is I intend to have $250,000 invested into 50 separate deals. That's our version of retirement. And it's going to give us a huge return, and we'll live on that for the rest of our lives. And one of the things that, and if you do the math, really, it only is going to take us about 15 years to get there with about $1 million. It's about 17 years. With a single $1 million, we're going to be able to reach that level in something along the lines of 17 to 20 years.
Just passively.
Passively. That doesn't count any earnings from our active efforts whatsoever.
Yep.
So, our version of retirement is 50, 50, 50, 50, and it all turns into huge amounts of cash flow for the rest of our years. And by the way, also, last thing I'd like to reiterate on that money is that $64,000 is probably paid to you tax benefited or tax deferred. So essentially, you would not be paying any income taxes on that money because we utilize depreciation to offset the income, and it's zero. It generally reaches to about zero. So those cash flow distributions usually have your K1 after you've received your distributions. Your K1 at the end of the year is usually close to zero.
Yeah.
In fact, on Park Hills, it was about 90% depreciated in year 2.
Yeah, that's the asset in the photo on this slide here.
Yeah.
So
and get in. Yeah.
Sorry. Go ahead. We get really passionate about this, but just to, also throw out the disclaimer that you need to consult your tax advisor for your specific situation before thinking you're not going to have to pay any taxes on anything, because everyone's situation is unique, and we are not accountants.
No.
So
speak to your lawyer, accountants. Happy to give referrals out as well. And you can utilize self-directed IRAs and solo 401ks. So you can invest this way with your retirement money outside of the stock market. I have referrals to be able to give if you need someone to help you set up something like that. Or you can also utilize, overfunded life insurance or whatever. Yeah.
So, I got started by refinancing my house and pulling some cash out, but it's not necessarily the best time to do that. So
interest rates were 3 back then.
Yeah.
It's living in the past.
That was back when I, reduced my mortgage payment by pulling out equity.
So
I wish for those days.
We'd love to open it up to questions from the audience. So anybody in the room have a question that we can answer at this moment? No?
Raise your hand.
Hey, Lee and Meagan.
Oh, Joe.
Joe.
Hey guys, how are you? Nice to see you.
Hey, Joe.
I saw
Wonderful.
Claudio Sanchez. He did ask if you could invest more than the minimum of 50,000.
Yes.
Oh, yes. Oh, yes.
Yep. So we had
50 is just the minimum.
50 is the minimum on our most recent project, which there's several of our investors in this room right now who invested passively in our most recent deal in Fayetteville, Arkansas. The minimum was 50, and we had several investors come in with 50, and our largest single investor put in $500,000. So the range on that particular deal, we had a total of 56 investors on that project, and it was as little as 50 and as much as 500 that came in from our passive investing partners.
Anything else? Any other questions? Thanks, Joe. Appreciate it. Good to see you. Right.
I know Claudio has a question.
Yeah, he wants to invest more.
Exactly. I want to invest more. That's and I know how to get in touch with you. So
There we go. Hey, Claudio, too. Thanks for the sweet microphone suggestion.
Yeah.
We got this
Oh, there you go.
Yes.
Lee's birthday question or
Mhm.
birthday present. You can't see it, but all right.
I have a question real quick.
Sure.
So is the intention with, and I'm new to syndication, so I'm still kind of learning a lot of this stuff with syndication. Is the intention with the initial investment to keep it invested in any of these properties from 3 to 5 years and then refinance into a new property? Or is it to just keep it into that current property? Or you're saying that there's new investment opportunities, so we would take our initial investment or that initial investment plus any equity that's in the property into a new property?
For sure. So we should explain. So our typical syndications are structured to be only 5-year holds.
Mhm.
Sometimes you can sell a little early. Sometimes we have business plans that go to 7 or 10 years. But typically we only hold it for a handful of years. And then once we achieve the numbers that we're looking for, and the calculator math works, then we sell the asset. Or if the business plan calls for a refinance, then we will refinance the asset. But eventually the goal is to sell.
Yep. The goal is to sell. Our general structure is 2 different types. It's either what I commonly refer to as a refi and roll project, where we'll buy an asset, which this is how we structured the deal that's pictured in the slide that you see here. We buy the asset. We increase the value by decreasing expenses and increasing the overall net operating income. We wait until we can reach a place where we can refinance and return 100% of our investors' capital back to them. And then we keep the property for a total of 10 years. So that gives you the opportunity to be able to have your capital back in your hands, to be able to redeploy it into another asset. So that's one structure. The other structure is a solid 5-year hold where we'll buy it and we will keep it we'll increase the value, of course, through value add business plan, decrease expenses, increase income, and then we'll trade out of it or sell it in 5 years. And ideally, at the same time, we have another opportunity for our investors to be able to, place their capital in the future. So the goal and the way that the money continues to recycle upward and increase your cash flows is through the sale. When we sell, you take your equity, the appreciation that we've created on the asset, and you keep it in the investment strategy. It doesn't have to all be in the same deal. You can diversify if you'd like, but you take that capital and you invest it into the next project. And then when we sell that project, you would take that capital and you invest it into the next project, and so on and so forth. There's also a wonderful scenario where you can run the numbers on what it looks like when you take your cash flow distributions, which is essentially a dividend. That's a common concept in the stock market world, is dividends. Well, there's this thing called the DRIP, dividend reinvestment plan. And you take your dividends and you reinvest them. Why? Because then it creates the snowball effect. You can do the same thing, and we just suggest doing the same thing with your cash flow distributions. When we distribute your 8% preferred return to you, we recommend setting it into a vehicle that earns a very low rate of return. I'm talking about like a money market account that gives you like 4 or 5% today, which is very high. But you keep it in there, so it's continuing to earn interest, or you use it and then you build that up until it's 50,000 again. And then you have enough to deploy into another project.
And then you're diversifying, you're spread out in multiple syndications, in multiple markets, and
and even multiple asset classes with multiple syndicators. So I would never be so greedy to think like you're going to invest 100% of your, investment with us in our projects that we do. No, abundance mindset. There's other people that do great as well. You can buy Pepsi and you can buy Coke and you can buy Budweiser. They're all drinks. It's just, which one gives the best dividend and which one would you prefer? Me, if I had to choose, it'd be Budweiser because I'm,
we're in St. Louis,
we don't drink
for the
Cokes.
record.
Yeah.
But yes, there's a very long answer to your question.
And are those quarterly distributions? Are they annual, or like how does that work?
Quarterly. Yeah.
Yes, there are quarterly distributions that you make during the hold period. And then that appreciation, the big appreciation and equity return of your investment is at the sale. And at that point, you can keep it or you can redeploy it into another syndication.
And are your projects, are they typically, apartment housing like this, or do you guys ever do like short-term rental vacation type of projects?
So both?
Yeah, I generally with syndications, or with us, we are very good at one thing, and
Yes.
it's large scale multifamily real estate. Now, will we eventually have like a vacation house? Sure, but
So I say that because specifically, so our base business plan is always 100 to 250 unit multifamily apartment complexes with a value add opportunity. It's always our base business plan. And we'll always underwrite conservatively to just long-term tenants with modest rent increases because we never want to overpromise and underdeliver. So we're always very conservative with our underwriting. We're always going to make sure that we can perform the business plan with the traditional business plan. However, if we're doing really well in business, we will get creative and see how we can make you more money. And for example, at this property here in the photo, we are currently putting in place a midterm rental opportunity for travel nurses. We've also had other apartment complexes that had an opportunity for Airbnb, and we've had 2 short-term rentals that performed very well at an apartment complex that we owned. So, this is always our base strategy. Large commercial size multifamily value add assets. However, sometimes we get to have fun and incorporate other types of real estate strategies into our core business plan.
we get to get creative when the property is stabilized and we know that it's functioning very, very well. And we get to start exploring new fun ways to do better than we're already doing.
Right.
The travel nurse units we just put in place at the, at Arbor Ridge, which is part of this 3 property portfolio that's in the photo here. Really excited about that. We're going to start with 1. It's my goal to get to a minimum of 4 of those because we generally find that we can get around 200 to 250% rent from a 30-day to 120-day midterm rental is kind of what we call it, whether it be a traveling nurse or a traveling professional
Or an insurance.
placement. Claim placement.
Mm-hmm.
And we did do very well with our Airbnb units at another apartment complex where we converted 2 units into short-term rentals.
Right.
And they earned at, I would say, 5 times what we would have gotten. We probably would have gotten $1,000 a month for them, but we were bringing in an average of $4,500 per month per unit on short-term rental in an apartment complex.
Right. And just our base business plan for those 2 units was long-term rental at long-term rental rent rates.
Yeah.
So all we did was just turn that 1 long-term rental unit into like 5 long-term rental units worth of cash flow.
Yep. Worst case scenario, you just rent it to a regular tenant.
That's right. That's the fallback plan.
You know what the worst case scenario is of buying a house in the Poconos? Yeah, now you have to sell that house in the Poconos if it's not successful as an Airbnb.
Yeah.
Or wherever it is, Tahoe, it doesn't matter. Hopefully you love it.
Right.
Yeah.
Right. All right. Anybody else?
Yeah.
This has been great.
I have a weird question. Do you ever have a situation where you have too many investors and you have to tell them, I'm sorry, I have too many, you have to go to the next, you have to wait for the next deal?
It's a very unfortunate but good problem to have. And yes, we have. We just had that on our last deal. All of our investment opportunities are first come, first serve. And, there's a lot of people that are like, yes, absolutely. But then, signing documents and wiring money takes longer than planned. Sometimes it's no fault of their own. Sometimes they're, selling another asset and they have to wait for it to close or, whichever it is. But the hard truth is if other people wire their funds before you and we fill up before, then you have to wait for the next deal. So we can't over collect because it affects our returns to our investors that are currently invested.
Yeah.
Thank you.
I think we had 3, came in right at the very end that we ended up having to
Turn away.
turn away. They signed documents and were prepared to wire money, but we had another investor fill the remainder of our raise, and we had to say, hey, even though you signed the documents, you didn't get your money in on time.
Yeah.
Thank you. We'll hit you up on the next one.
Right. All right. Anybody else? That was a good question, by the way.
Yeah.
All right. And if you think of a question or even just want to talk through a scenario, please email it to us at email@greenforestcapital.com, and we will consider answering your question or going over your scenario on future episodes of this webinar. It's a great opportunity for us to give value to you and also for us to have more ideas for content. So please feel free to email your questions, scenarios, anything like that you have for us. Email Green Forest Capital, and tune in again next month and in our following webinars so you can see if we end up answering your question.
Yeah. Tours and Pours is going to be on Thursday this week. So for anyone who's in St. Louis or interested in traveling to St. Louis by Thursday, come on out. It's going to be an amazing event. We're going to be touring an amazing project in the basically the Slough neighborhood,
Midtown of St. Louis
called
City.
Icon Apartments. It's 150 units owned by a
housing.
local developer here in St. Louis. We go and we tour the property and then have an opportunity to learn about different properties. And then the next webinar will be on the 11th of July, and it will be with a guest loan placement. Actually, it's like a mortgage broker, an agency debt mortgage broker.
Yes.
Who placed the debt on this property that you see here in the photo. So, yeah.
All right, y'all.
Yeah.
We don't want to take up any more of your time tonight, but thank you so much for attending our inaugural webinar, and we hope to see you again next month.
Yeah.